Hey everyone, this is Finding Value. I'm going to do a quick recap of this is going to be extremely high level. I know we've got new subscribers, new people watching this channel, and a lot of my earlier videos go over this, and I'm just going to recap it up real tight and short and brief with precious metals and why they are superior to go into at this time it's in their cycle. So I'm going to jump right in and start talking about some of this stuff right now. So this is a long-term chart of a 10-year Treasury bond yield. When yields are increasing, they are favorable. Usually it's inflationary and favorable for metals and commodities. Declining is typically better for stocks. So what you'll see is stocks probably outperformed in this general area. Commodities, precious metals, and real estate outperform during this cycle. And then obviously in these big cycle down here, stocks definitely and bonds outperformed when interest rates decline. And I think we're going to be bottoming here pretty soon, probably within the next year or two. And that's when maybe they hold rates low for a very long time. But holding rates low will lead and have consequences, and we'll cover that in a couple slides later. So I think that the timing is very good for precious metals and a lot of commodities and also real estate. This is the Dow to gold ratio. Obviously, it's a short-term chart here. Declined quite well. We shot back up, and now we're declining again, which means that stocks outperform when this goes up. Precious metals outperforms when this ratio declines. And we're in a declining environment, which means precious metals or gold is outperforming stocks. It is increasing purchasing power against stocks. Next, this is the real rate. So what I want you to notice here is that when rates go negative, that's what this light purple is here. That means that real rates are negative. It means that the inflation rate is higher than the Treasury bond yield. So you're getting a negative real rate. People exit bonds and they go into precious metals and other assets. So this is gold price. This is the rates. So whenever you have positive rates, gold does not like positive rates, so you'll see it decline over time. When it goes negative here, it wants to jump higher. Again, the increasing positive rate here, decline, decline, decline. And whenever it starts to decline back to a negative rate, you'll see it turn and peak up. The one thing to notice is that I think we're going to have real negative rates, and it's probably going to get a pretty large real negative rate. So going forward, the Federal Reserve has said that they're going to hold rates low, 10-year Treasury bond, and they're going to let inflation run. So that means that real negative rates could get pretty large. And the larger the real negative rate gets, the higher gold price is going to go. This is the monetary base and gold. So this is the price of gold and the backing of the monetary base. This is 40% backing. This is 100% backing. If we were to go back to 1980, we could have went back on a gold standard in 1980. What's coming up, a lot of people think that gold's going to go to a 40% or 100% backing, which means that prices are going to go far, far higher. Now, this is an old chart. These prices are way higher than this. And I'm going to go to a more recent clip. So this is 2010, 2015-ish or so. And the money supply now looks something like this. So that chart was here, and it is far higher. So prices have a long way to move up. This is the Huey in relationship to the S&P 500. And all I want to show here is that the Huey broke out in relationship to the S&P 500. So gold miners are going to outperform stocks. And we're right at this big downtrend that we broke out. So we have a lot of positive development for gold miners in front of us. The Huey also broke in relationship to the price of gold. So we have two indications that the mining companies are going to outperform. This is another thing I'd like to talk about. This is gold price in British pounds. Remember what we did in the US dollar. We broke to 2000 and now today we're pulling back. If you look, here is the old high. This country's gold price broke to a new high above this high here and then pulled back into this support here, just like we're doing right now. Then it took off. So I have a feeling that our gold price is going to mimic the price of the British pound. Now, we went over some stuff here. So we have real negative rates, which is positive for gold. We have a declining Dow to gold ratio, which means gold is going to outperform stocks. Gold is cheap in relationship to how much money is in supply. We have the mining companies that are going to outperform. And we're looking here at what is cheap in the precious metals arena, because we know gold's going to go higher. And if gold's going to outperform, we want to get the most undervalued metal and accumulate that undervalued metal if the environment is a precious metals positive environment. So this is platinum to gold ratio. And I put some lines in here just to show that this is when it gets cheap, it goes below this line. We are cheap, and it is extremely cheap. Platinum is cheap in relationship to gold. Platinum is now, I just charted it here, was $35 or 35. 1 ounce of platinum can buy 35 ounces of silver. So platinum is cheap to silver at this low rate down here. And platinum to palladium ratio is very cheap. It's never been this cheap in the history of following this stuff. So, tying this all together, we need to pick up some mining companies. I think gold price is going to go higher at some point. Even if we're wrong in the short term, I still think it's going to go higher in the medium to long term. And we need to buy our ounces of platinum because the ratios are a screaming buy. And I've got some video clips, you can look at them about platinum. You can look at the supply demand imbalances, where they occur, and see exactly what it looks like from a supply demand balance. We're in a surplus right now. It's a great time to purchase. We will eventually go into deficit. It may take a little while, but you got to keep in mind that investor demand will also increase if the precious metals increase. So this is Finding Value. Hopefully this recap of kind of a lot of the videos I've done puts this all together to paint a picture that is positive for precious metals mining companies, and also the metals themselves. Also keep in mind, I've done some clips on royalty companies. I think royalty companies should be in your portfolio and should be a good percentage of your portfolio as they have a superior business model. So this is Finding Value. Thank you for listening. Subscribe, rate, comment, and appreciate your time.